Sunway Berhad stock has been on fire lately, but just a few years ago, nobody really paid much attention to it. But now, everyone is watching it closely, and it's all because Sunway Healthcare is said to be going public. But why does an IPO for just one of Sunway's businesses suddenly make the entire stock price explode? What is Sunway Berhad doing differently to help the market understand the real fair value of the company? To understand what's really happening, we need to rewind back to 2014. Because this one corporate move might just be the most important moment in Sunway's entire history. This is so different. Sunway Group was founded in 1974 by Tan Sri Dr. Jeffrey Chia, who had a vision to transform a 350-hectare tin mining wasteland into what is known as Sunway City. What seemed impossible at the time became one of Malaysia's most well-planned and successful township developments. This ambitious transformation not only showcased Sunway's ability to turn challenges into opportunities, but also set the foundation for its future endeavours. Over the decade, Sunway grew into a massive conglomerate spanning multiple industries. It built a name for itself in property development and construction, establishing itself as a major player in real estate. It also ventured into education, launching Sunway College in 1987, which later evolved into Sunway University, a premier institution in Malaysia. Healthcare became another significant focus with the launch of Sunway Medical Centre in 1999, which eventually expanded into 5-tower hospital complex, making it Malaysia's largest private hospital. Sunway also expanded into hospitality and leisure, launching Sunway Lagoon in 1997, a theme park that became one of the country's most visited tourist attractions. The company seemed unstoppable, growing rapidly across industries and established a strong reputation for its ambitious expansion plans. However, despite its growing business empire, there was a problem. Even though Sunway was making money and expanding aggressively, its stock price maintained undervalued. Sunway's growth was fueled largely by debt. It borrowed massive amounts of money from banks to fund its expansion, a strategy known as gearing or leveraging. The idea was simple: borrow money, build assets, and generate even more returns. As long as the company continued growing, this strategy worked. But as Sunway's debt increased, investors became worried. The company's debt-to-equity ratio, which measures how much debt a company is using to finance its operation, has reached concerning levels. At one point, Sunway's gearing ratio was at 91.3%, meaning the company relied heavily on external loans. For context, imagine you buy a 1 million ringgit house but take out a 900,000 loan to do so. If the house appreciates in value and your salary increases, that's great. But if your income remains stagnant or declines, that much debt becomes a serious problem. Investors viewed Sunway's situation in a similar way. Even though the company was expanding and making money, its heavy debt load made it look very risky. But that wasn't the only issue holding the stock price back. There was another problem, one that many large corporations face. The other major issue was something called the conglomerate discount. When a company owns too many different businesses, investors often don't know how to properly value it. Large fund managers, in particular, prefer investing in focused companies rather than diversified conglomerates. For example, if an investor wants exposure to healthcare, they would rather buy shares in a pure healthcare company than a conglomerate that owns hospitals, shopping malls, hotels, and construction projects. Large fund managers believe they can pick better investment themselves rather than rely on a company that is juggling too many businesses. Because of this, conglomerates often trade at a discount compared to their actual value. Investors don't want to pay full price for a company with too many moving parts, and Sunway suffered from this perception. Even though its businesses were strong, the market refused to assign a higher valuation to the stock. Then came 2020, and everything got worse. When the COVID-19 pandemic hit, Sunway was in serious trouble. Construction projects were halted, property sales dropped, and shopping malls were all empty. The hospitality business also suffered as tourism came to a standstill. Sunway's cash flow was severely impacted, and to make matters worse, banks started tightening their lending measures. Banks typically lend money when businesses are thriving, not when they are in trouble. This meant Sunway could no longer rely on bank loans as easily as before. With high debt and multiple businesses struggling due to the pandemic, Sunway was facing one of the toughest financial situations in years. If Sunway didn't figure out another way to raise money, it could have been in serious financial distress. In June 2021, Sunway made a bold move. The company decided to sell a 16% stake in Sunway Healthcare to Singapore Sovereign Wealth Fund, GIC Private Limited. The shocking part, GIC paid 750 million ringgit for just that 16% stake. That meant the entire Sunway Healthcare business was suddenly valued at 4.6 billion ringgit. To put this into perspective, at the end of 2020, Sunway Berhad's total market cap was only 7.8 billion ringgit. That meant Sunway Healthcare alone accounted for nearly 60% of the entire company's value. Investors were stunned. They realized that Sunway stock had been severely undervalued all along. This was the moment when investors really started to pay attention to the stock. One of the key figures behind this transformation was Dato Sri Idris Jala, who was appointed as co-chairman of Sunway Berhad in 2017. Idris Jala had a legendary track record. He was a former Shell executive who worked across multiple countries before becoming the CEO of Malaysia Airlines, where he successfully turned the company profitable in just 2 years. Because of his impressive results, he was later appointed by the government to lead Pemandu, a transformation unit aimed at improving Malaysia's economy. At Sunway, Idris Jala played a key role in addressing the conglomerate discount issue. The management team was frustrated that despite creating so much value across different businesses, the market didn't recognize it in the stock price. The healthcare deal was a game changer because it forced investors to acknowledge the hidden value in Sunway's business empire. Before the healthcare deal, in May 2021, Sunway's stock was just RM1.59. Fast forward to today, and it's trading above RM4.30, valuing the company at 27 billion ringgit. That's a 170% increase in just 3.5 years. Investors finally realized how much value was hidden in Sunway's businesses, and the stock price reacted accordingly. To understand how much Sunway is really worth, let's break it down using a method called sum of parts valuation. This approach values each of Sunway's key businesses separately and adds them together to get the total worth of the company. Here's what Sunway has today. Number 1. Sunway REIT has a market cap of 5.3 billion. Sunway Berhad owns 40.89%. making its stake worth 2.17 billion. Number 2, Sunway Construction. It has a market cap of 4.45 billion ringgit. Sunway Berhad owns 54.42%, making its stake worth 2.42 billion. Number 3, Sunway Healthcare. It is now estimated to be worth, say, 15 billion ringgit. Sunway owns 84%, which is 12.6 billion. Adding all these together, we get a total value of 17.19 billion ringgit. This excludes other business segments like trading, manufacturing, and quarrying, which means Sunway's true value could be even higher. Currently, Sunway Berhad's market cap is about 27 billion ringgit. This means the stock is finally being recognized for its real value. And now, we are entering round 2 of value unlocking. First of all, how did I know Sunway Healthcare is valued at 15 billion ringgit? There's news that Sunway Healthcare is getting ready to go public, and the numbers are staggering. Analysts estimate that Sunway Healthcare's IPO could be worth between 12 billion to 20 billion ringgit, making it one of Malaysia's biggest IPOs in recent years. So what I did there was to get a middle point as my estimates, 15 billion. Compare this to the 4.6 billion ringgit valuation back in 2021, this IPO suggests that Sunway Healthcare's value has more than doubled in just a few years. The company has expanded aggressively, hiring top doctors and increasing its hospital network. Sunway now operates 4 hospitals, with 5 more under development, a testament to its long-term growth strategy. Today, we have taken a deep dive into why Sunway's stock price has exploded in recent years. We started by looking at Sunway's rapid expansion across multiple industries, property, construction, healthcare, education, and more, which made it one of Malaysia's biggest conglomerates. Then, we uncovered the challenges that kept Sunway's stock price low for years. High debt levels made investors uneasy, and the conglomerate discount meant that the market wasn't giving Sunway the valuation it truly deserved. When COVID-19 hit, the company found itself in a tough spot. Projects were stalled, malls were empty, and banks weren't willing to lend money as easily as before. That's when Sunway made its game-changing move in 2021. By selling a 16% stake in Sunway Healthcare to GIC for 750 million ringgit, the market suddenly realized just how undervalued the company really was. Sunway Healthcare alone was worth 4.6 billion ringgit, which was 60% of Sunway Berhad's total market cap at the time. That one move changed everything. Sunway's stock price began to rise, and investors started paying attention. To put things into perspective, we broke down Sunway's true value using the sum of parts method, a common way investors analyze large companies like this. By adding up Sunway's stakes in Sunway REIT, Sunway Construction, and Sunway Healthcare, we estimated that the total intrinsic value of these businesses alone could be worth around 17.19 billion ringgit, and that excludes other segments like trading, quarrying, and manufacturing. Now, as we approach the biggest event in Sunway's history, the IPO of Sunway Healthcare, investors are watching closely. Analysts estimate that Sunway Healthcare could be valued between 12 to 20 billion ringgit, making it one of Malaysia's largest IPO. If the listing goes well, it could unlock even more value for shareholders and push Sunway's stock price even higher. So, after everything we have discussed today, do you think Sunway's stock will continue rising after the IPO? Will we see it break past 5, 6 or even 7 ringgit per share? Let me know your thoughts in the comments.